Move, the RBI's Monetary Policy Committee today unanimously decided to keep the repo rate unchanged at 6.5%, emphasizing that it is a pause and not a pivot. The governor kept a window open for further rate hikes and said that the MPC will not hesitate to take any action in the future. So what does the pause mean for markets and investors? How will it impact us going ahead? Let's answer all of these questions with Dhaval Dalal, CIO, Fixed Income Edelweiss AMC, and Akhil Mittal, Senior Fund Manager, Fixed Income Tata Mutual Fund. But before we begin our conversation with our guest, let's first hear out what Governor Shaktikanta Das had to say earlier today and the reactions coming in.
The Monetary Policy Committee met on 3rd, 5th and 6th April 2023 and assessed the macroeconomic situation and its outlook. It decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting with readiness to act should the situation so warrant. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me emphasize that the decision to pause on the repo rate is for this meeting only. If I have to characterize today's monetary policy in just one line, I would say as follows. It's a pause, not a pivot. Number 2, there has been an effective rate increase of 290 basis points over the last 1 year, including the SDF 40 basis points rate increase. And this 290 basis points increase, in fact, has translated to a monetary policy transmission by way of increase in the overnight call rates. India's real gross domestic product, that is GDP, is expected to have recorded a growth of 7% in 2022-23. Hence, economic activity remains resilient. The real GDP growth for 2023-24 is projected at 6.5%, with Q1 at 7.8%, Q2 at 6.2%, Q3 at 6.1%, and Q4 at 5.9%.
Market is expecting inflation to be little ahead of RBI's projection. There is a positive base effect coming in. And if we don't get a bad monsoon, which is expected, then I think inflation number will remain under control. For us, also another watch is oil price movement. Earlier, oil price used to move based on demand and supply. Now they are moving more based on OPEC's cartelization. So oil and monsoon continues to pose a risk on inflation on the higher side than expected. But let's hope and pray that we'll be lucky. When money comes into mutual fund, there is a higher multiplier effect because we put our money in bank account. There's no leakage in terms of SLR, CRR. When money comes into banking system, there is a leakage in terms of CRR. There's a deferment in terms of SLR or credit outflow or credit deposit ratio. And overall money multiplier may get impacted. I fully agree that there should be a level playing field. But banks were at a much higher risk from insurance companies than mutual funds. Debt mutual funds as a percentage of bank deposits have declined over the last 10 years. And my fear is that the money multiplier and money supply growth will get adversely impacted because of this exemption taken away.
What RBI today has done is it's clearly told us that discretion is better part of valor, right? We are not having a death wish like the US Fed and the US economy. They keep raising interest rates violently. I mean, nearly 500 basis in just 1 year flat, right? 12 months flat. And I think RBI has been very, very reasonable in terms of the assumptions. If you look at what they've changed in terms of inflation, from the February policy, they said 5% in Q1 and 5.4 in Q2. They haven't really changed it much, Maithili. They are saying now that 5.1 in Q1, which is just a 10 basis change. Q2 remains unchanged. So if you look at the growth and inflation numbers broadly, and we should be cognizant of the fact that in the next 5 to 6 months, the base remains really favorable. And if I just take an average, it should be giving about 55 to 60 basis, depending on which month we're talking about. So I think they are not really taking their eyes off inflation, and the forecasts also seem fairly reasonable. With all the rate hikes that have been done, especially in the advanced economies, they hardly have anything to show for, right? It's really cratered growth in particular segments, and so far we are not seeing much impact on inflation. So I think the RBI has done the right thing, and I think price stability has now given way more or less to financial stability. And like I said, discretion is better part of valor, and we can wait and watch, let some data come in, and then we can then move ahead.
All right, so that's the view, the voice on the channel that came today morning. But then let's connect with Dhaval Dalal and Akhil Mittal. Dhaval and Akhil, good evening. Thank you so much for joining in today. And first question, Dhaval, how would you explain the rate hike pause?
I think what the Reserve Bank of India has done has clearly surprised the market participants, but it's the right thing to do. We always believed that the April policy is going to be a close call, given the fact that inflation after rising in Jan and Feb is likely to trend lower very, very sharply. And as per RBI's own forecast, it's going to be Q1 average inflation is going to be close to 5.1% as against 6.4% that we are seeing right now. So inflation is going to be far, far better from market participants' perspective, whereas the economic growth is something that everyone is feeling that given whatever has happened in the global financial markets with regards to banking crisis and other things, could possibly pose a headwind. Now, here the RBI is probably an outlier in terms of their growth forecast for FY24, where they are talking about growth at close to about 6.5%, whereas most of the other market participants believe that the growth could be lower than 6.5%. So clearly, the government ahead of the election and the RBI being the banker to the government are clearly aiming to ensure that the growth remains in focus and priority. So from that perspective, holding rates at present level, particularly when inflation is going to trend lower, and give the market some time for the previous rate hikes to start acting is probably a prudent thing to do in our view. So from that perspective, I think the market participants will probably rejoice the current move. The only thing that we need to keep in mind is that the inflation, which RBI governor themselves has said that they are vigilant about it, should not should probably remain on the expected path and should not throw any kind of negative surprise going forward. Otherwise, RBI probably rate hike is going to be back on table in June.
Which is why I think this pause. But then let's dissect this one by one. And Akhil, although there is a pause, but there is no such signal of it being one of the many. In fact, there are indications that it could be one of the pause depending on the global trend or the global scenario. Now, how would you look at the global scenario right now and compare it, or maybe analyze RBI's today's move in context with the global trend?
So to start with, our expectations, we were an outlier in the market. We had expected a pause in the policy. And now, RBI has done a cumulative of 290 basis of effective tightening in the system from 335. The operating rate is now at 6 quarter. It takes time for these things to, then percolate into the real inflation numbers. And also given the fact that the repo rate is already ahead of the current inflation number, it's not that any further rate hike would have helped the economy in any which ways or tackle the inflation in much harder ways than it already is. Now, RBI sounded off concerns on fragility of financial system globally. Now, those concerns are for real. It's not that we can remain aloof from what is happening around in the world. So especially the sentiment side of it. And given the fact that, expensive money will have its impact on credit growth going forward. That combined with the bad sentiments, if they were to prevail, would not bode well for the growth of the economy. Now, we have to remember that 2022, RBI front-loaded the rate hikes to tackle inflation head-on. And once the animal of inflation is under control, it cannot actually give away the goal of growth. To nurture and foster growth over a longer period is also very important. So I think in that backdrop, given that global financial markets are passing through a bit of turmoil, are passing through a bit of uncertainty, it's a wise thing to do that. Give yourself some time, see off the volatility in the market, see off the fragility in the market, and thereafter have a fresh look at the numbers on how they how they transpire, what's the trajectory unfolding like, and that's how I think today's policy was expected, at least at our side, and that's how it has largely been portrayed. As far as one-off or consistent is goes, I think it's not a one-off. Given the trajectory of inflation that RBI has printed, you really have to have a out of whack negative shock on inflation for rate hikes to be back on table. Minus that, I think we are done. When RBI says it's a one-off, it's a pause and not a pivot, it basically means on a timeline and not on the scale of rates going up or down. So I think the pivot point in terms of absolute number is close. In terms of timeline, might be slightly away, but definitely as far as our reading goes, we do not anticipate any further rate hikes.
All right, Dhaval, now let's talk about the inflation number, which came marginally low in terms of expectation that the RBI has quoted. Your take on this?
Well, I think right now the RBI has basically reduced the inflation forecast or average inflation forecast for FY24 based on the reduced crude oil prices from $95 average price to about $85 an average price. Now, we just hope that the oil prices remain where what RBI is trying to project, given the fact that oil prices have remained pretty volatile in the past, and given what OPEC Plus group is trying to do with regards to raising oil prices, this is something that market participants are keenly watching. Now, at the same time, we are all aware of the fact that global economy is going through a little bit of slow patch, right? So a slowing global economy will reduce the demand for oil, whereas on the other hand, the Chinese economy is now gradually improving. So you have the push and pull from both sides, which is going to be interesting to watch their impact on the oil price going forward. But we would believe that given India is able to buy crude oil from Russia at a discounted price, and then there are other resources as well. So we believe that crude oil prices should remain below the expectations. That's one thing. Second thing is the food price. I think right now the food prices remain very, very important for us given their weight in the index, in inflation index, about 40 to 45%. And currently we are seeing there's a lot of volatility coming in the food basket. We look at the milk price, you look at the wheat price, you look at some of the pulses and some of the protein prices. I think they have remained pretty volatile. And this is something that we will have to keep an eye on, particularly at a time where weather-related vagaries are keeping food prices volatile. So these are the two main aspects which we believe are likely to play an important role going forward on the trajectory of the inflation. And this is something that we'll have to watch. And I think the Reserve Bank of India is keeping their fingers crossed with regards to expecting a normal monsoon and lower negative impact because of the El Nino and energy prices remaining in the check. So these are the three things we will be watching. And if there is any significant deviation, that's why RBI has probably kept the door open for a potential change in the monetary policy down the road.
Akhil, what about the currency weakness? Do you think the pause will impact the currency movement and maybe a hike would have stopped the weakness? Akhil?
Not really. I mean, yes, at the margin, you can say a hike would have slightly, being more favorable towards rupee. But actually, if you see, there's no material change that a hike or a non-hike has done to the currency, given the fact that our deficit numbers have improved significantly. the exports have increased and imports have also been managed well. Also combined to that fact that we are some of the EMs, favored EMs, we are one of them. So the flow of money is okay. The trade packs are going okay. So I don't see interest rate defense wall being needed to heighten to manage currency. In fact, if anything has to go, I think we have already reached a height of defense wall, which is apt and optimum. I don't see any reason why RBI would have been too concerned about INR and then use rate as a defense for that.
Dhawal, now if we have to talk about the yields now, what do they indicate?
Currently, I think the market has reacted in a knee-jerk manner with the way yields have declined. But as the dust settles going forward, we do expect the yield curve to start bull steepening. That means short-term rates will probably fall more faster in terms of a basis point as compared to long-term rates, long-term yields. Now, over here, I think at the short end, we know that the 1-year T-bill was close to about 7.25%, based on the expectations that the repo rate will probably be 6.75% or even higher down the road. That is what is being priced, and now it is going to get unwound. So we do expect short-term yields to gradually trend lower. On the long end, on the other side, I think given the first half, the borrowing program has increased the amount of auction for 15-year plus portion of the yield curve, and given the recent changes in the tax law, if it's going to make a material impact on the demand of the long end of the yield curve, we could probably see the long end of the yield curve remaining a little stickier, whereas the short-term yields will gradually start trending lower as market participants begin to factor in a pause for calendar 2023 and potential rate cuts down the road. So from that perspective, we do expect the yield curve to gradually start steepening from here. And importantly, whatever happens in the US treasuries will also have its impact on the sentiment of the market participants.
So when you talk about double steepening, what is the number that you're talking about?
So we do expect the 10-year to trade in a range of 7.15 to 7.25% in the near to medium term, given the fact that with repo rate close to at 6.5%, and the average term premium of about 70 to 75 basis points. So that's where the fair level for the 10-year will be close to about 7.25%. But given the significant improvement in sentiment among market participants and the need to add duration, given the robust flow that we have seen in the last week of March, I believe that the 10-year yield is likely to trade at the lower band of its trading range of about 7.15 to 7.25%. Whereas on the 5-year, we believe that the spread between 5-year and 10-year should gradually start widening, as the 5-year will also get pulled lower during the steepening process.
Akhil, what's your take?
I think for now we'll be in 7.15, 7-quarter zone, as Dhawal has mentioned. But going ahead, I think 6 months, 9 months down the line, we should be moving towards 10-year benchmark. GSEC should be moving towards 7% or lower. Our entire premise is that as inflation comes down, every policy RBI will give you a 12-month forward pan chart. As soon as you see the forward inflation number, 12-month forward inflation number moving sub 5%, that point in time, you cannot have a policy rate of 6.5. I think you will be looking at or discounting a repo rate cut then, which means it has to translate into market yield. So towards end of financial year, maybe end of Q3, Q4, we see 10-year GSEC sub 7%. As far as steepening goes, we see a parallel shift in the system, given that withdrawal of accommodation continues to be the stance, and RBI has said that liquidity is an important parameter of accommodation or withdrawal of accommodation. So we believe liquidity will remain very closely managed in such a way that RBI keeps operating rate the way they want policy efficacy to be. So in that sense, short-term curve might not react as sharp as what it did today. So we think a parallel shift and not really a steepening or a flattening, but a parallel shift in yields going down the line.
Last question to both of you. First, I'll start with Dhawal. Dhawal, time to lock in money for longer term now in fixed income? What do you suggest?
Well, we'll do like the area between 5 to 10 years part of maturity bucket on the yield curve. We believe that the long end is likely to remain stickier depending on the demand-supply dynamic that evolves as we discussed. But at this point of time, I think 5 to 10 year segment looks very, very attractive from relative liquidity as well as risk-adjusted return perspective as well. So we are advising clients to focus on 5 to 10 year segment of the yield curve with at least 3 to 4 year of investment horizon.
Investment instrument that you're recommending, given the fact that taxation benefit has gone on debt funds? Dhaval?
Yes. I think market participant will start looking for absolute return kind of returns, and from that perspective, I think the 5 to 10 year segment will probably give a decent carry plus potential price appreciation down the road as and when the rate cuts cycle begins next year. So from that perspective, I think it will probably provide a good carry plus potential price appreciation from 3 to 4 year holding period perspective, in our view.
All right. Akhil, what about you?
I think time to lock in money for longer durations, both on absolute and relative basis. The study says simple. Ever since MPC formation in May 2016, when it became a law, the paradigm of interest rate setting has changed. From then till now, we have largely 10-year G-Sec is traded in range of 6% to 8%. Currently at 727 quarter zone, we are at 65-70 percentile cheaper prices. Now related to the inflation dynamics that have emerged in the country, when we were a 9% inflated economy, we used to trade at 7.5. When we were 8% inflated economy, we used to trade at 8%. When we were a 7% inflated economy, we used to trade at 6.5, 7. We are a 6.5% inflated economy going ahead. If you are going to be a 5.5 or a 5% or a 4% inflated economy, you are not going to get these yields. So going for longer duration, longest durations possible. It will take time for interest rates to actually come down by a great deal, but over a period of time, you will see inflation coming off and interest rate yields or yields coming off across the curve, entire duration curve. So we can choose depending upon your investment horizon, your risk appetite. I would say go in for longest duration.
Right. So, right time to make the most of the interest rates which are high as of now. Thank you so much, both of you, for being on the show and helping our viewers and helping them understand the purpose behind the RBI policy today. On that note, we'll take a quick break, and post that, let's get your tax planning done for the new financial year. We'll help you understand whether you should be sticking to your old tax regime or it's the time to move to a new tax regime. And if you are someone who still wants to stay with the old tax regime, what all you need to do now as per your tax planning after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, with the new financial year well underway, it is time to start planning about your investments and tax liabilities smartly. So, on The Money Show today, we will help you do just that. We will tell you how you can manage your tax liability given all the changes that have happened recently. We will also help you decide whether you should stick to the old tax regime or migrate to the new one. Let's welcome on board Tapti Ghosh, partner, Deloitte India. Tapti, good evening and welcome to the show. We have a lot of questions which are sent to us by our viewers, but then I really want to start with the new tax regime breakup. Now, since that's a default tax regime, if at all you don't clearly mention that you want to stick to the old one, let's refresh and let's once again remind our viewers what exactly are the tax slabs under tax regime, what kind of benefits, few of them were introduced in the budget this time.
Thanks so much, Kavita, and thank you for having me on the show. Okay, that's a good place to start to understand what were the changes, obviously, and we've heard about this a lot, that the new tax regime has been made much more attractive in this Finance Act. First of all, the tax structure has been looked at again. The slabs have been rationalized. The number of slabs have come down to 5. And again, the basic exemption limit has been increased to 3 lakhs. And then with every increase of 3 lakhs, the tax rates go up from 5, 10, 15, 20, and 30. And so as compared to the past, across all levels, the tax liability will come down. just because of the way the tax structure has been changed. Over and above that, the rebate under 87A has been increased to 7 lakhs. It was 5 lakhs before. So currently, individuals with income up to 5 lakhs are not required to pay any tax, since the tax on such income is provided as rebate under 87A. And with this budget, with effect from 1st of April 2023, this rebate has been increased to 7 lakhs, which means that anyone getting income up to 7 lakhs under the new tax regime will not need to pay any tax. Standard deduction has been introduced under the new tax regime as well, which is a positive move. Earlier, it used to be only in the regular regime or the old regime. Then for the very high income group, that is for those above 5 crores, there's a reduction in the surcharge from 37% to 25%, making the effective tax rate come down from 42.74% to 39%. Which makes it absolutely attractive for those in those levels of income. But overall, it's not that all of these changes result in a positive outcome for all. It would need to be looked at on a case-to-case basis because under the old regime, there are a significant number of exemptions and benefits that are there,
right,
which are lost under the new tax regime.
Exactly. I don't know if it's possible for you, but then could you help us with the onboarding taxpayers which are there on the new tax regime as per new tax regime? Do we have such kind of a number, and is it more? Has it increased?
So till last year, of course, the numbers were not so good, which is why when we spoke to companies across, it was just about 5 to 10% that had opted in for the new tax regime, which is why the government has had to make these changes to make it more attractive. But we'll have to wait and see for FY23 how many would opt in. And the results really would be known when they start filing the tax returns for FY23, which are due 31st July, because that's when the individuals will have to make that choice for certain while filing the tax return.
So, Tapti, let's help our viewers in reviewing the kind of tax regime they should be sticking on to. I would request you to explain this, by giving us an example of someone who maybe earns somewhere between 7 to 10 lakhs yearly and 10 to 15 and then 15 lakhs on. Someone who's taking all the benefits as per the old tax regime, should there be any reason for them to, shift in or opt in for the new tax regime? In what should be the criteria?
Let me take 2 examples. I mean,
Sure.
For those below, say, 7 lakhs, as I mentioned, it's really not much of a choice to be made. There's no tax for those under the new tax regime, so we'll keep those aside. Let's take an example of somebody who has income from salary of about 15 lakh. Under both the regimes, you're entitled to a standard deduction of 50,000. You're allowed a deduction of profession tax of 2,400 under the new tax, under the old tax regime, and say the person has a housing loan interest and a deduction of 2 lakh is allowed under the old tax regime. Say the person has interest from savings and interest from FDs. That income is taxable, of course, for under both the regimes. The person may be staying in a rented accommodation and is entitled to claim a rent allowance deduction under the old tax regime. Say that's 1 lakh. The person is entitled to, say, a leave travel concession of 50,000 under the old. Taking an example, of course, these numbers would differ person by person. LTC of, say, 50,000. ATC deduction for, say, life insurance, premium payments, PF, PPF, housing loan, principal payments, say 150,000, which is the limit that's there. You could be contributing to NPS, an additional contribution for NPS, say of 50,000. Employer contribution to NPS could be 150. You could be having a Mediclaim premium of 25,000. Because you're earning interest from FDs, you'll be entitled to 80 PTA of 10,000. Putting all of these together, most, except for the standard deduction, none of the other deductions and reliefs are available under the new tax regime. So the outcome as such for a person at 15 lakh, you would have a tax liability of about 70,000 under the old tax regime and about 1,30,000 under the new tax regime. So obviously, if the amount of deductions and exemptions that are available are significant, the old tax regime wins hands down. And in this particular case, there would be a savings of about 60,000 rupees if they go by the old tax regime. So that's just one of the examples. We could take a similar case as far as somebody who earns 10 lakhs and with a similar kind of deductions and exemptions that are allowed under the old tax regime, but not allowed under the new tax regime. They would not need to pay any tax under the old, but would have to pay about 48,000 under the new tax regime. So in these cases as well, the old tax regime continues to be more beneficial. But of course, depending upon if the number of deductions and exemptions are not significant, then one would need to do a determination based on what is the quantum of investments, what is the long-term financial plans that an individual has. Do I have year-on-year housing loan interest, for instance, that has to be paid? Can I claim a house rent allowance deduction on a year-on-year basis that I can't switch off? Based on all of those, you need to really decide whether one works better as compared to the other.
This homework and this assessment needs to be done from the taxpayers' angle. But then I also want to understand how many times, salaried individual and businesses, can they opt in and opt out from the tax regime, new tax regime, or is it just once in a lifetime opportunity that you get to decide which tax regime you want to choose?
So on an overall basis, salaried or not salaried, if a person does not have income from business and profession, they can make a change on a year-on-year basis. Now, if I look at the perspective of a salaried individual, because there the tax withholding norms come into play as well. In fact, there was a CBDT circular clarifying the norms that was released yesterday, which basically said that if at the beginning of the year, the employer will need to seek information from every single employee as to whether they would want to go in for the default new tax regime, or whether they would opt in for the old tax regime. Remember that there is a flip from the current year, because the new tax regime is the default from this year on. And if the person does not make a choice, does not provide an intimation to the employer of his choice, then the employer goes with the default new tax regime. And that continues for the rest of the year. But at the time of filing of the tax return, the individual will, of course, need to specifically call out the option. And in the event that he chooses to opt the other way, as in go in for the regular tax regime at the filing tax return, he can very well do so at that point in time, but may possibly have to deal with some refunds at that point.
Sure. So,
are you with me?
Right. All right, so very crucial for taxpayers to figure out which tax regime to stick. And even if you plan to move on to the new tax regime, it's very important to hold on to your old tax regime investments that you might be just doing for tax benefit, but you need to sit down and analyze all of those investments now and then align them with the financial plan and strike out the ones which are really not needed, or maybe the ones you were using only to save tax. Thank you so much, Tapti, for being on the show and helping our viewers with that today. On that note, we'll take a quick break. Post that, let's get your portfolio related queries answered by Arnav Pandya. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Arnav Pandya, founder Money Edu School. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. So that's the WhatsApp number and email ID. But good evening, Arnav. Welcome to the show. We have Lalit Mehra's question for you. And so he's been doing SIP every month in HDFC Midcap Opportunity and Kotak Emerging Equity Fund, 5,000 each. And his investment time horizon is 15 to 20 years. He wants to understand if he should be adding more funds in the portfolio. Unfortunately, we don't have Lalit on the phone line, so then we could have asked him more questions related to his goals and the kind of corpus he wants to accumulate through these funds. But talking about the selection, you think he can diversify more?
Good evening. So, if you look at Lalit's portfolio, there are two funds in there, and both of them are mid-cap funds. So, HDFC Mid-Cap Opportunities as well as Kotak Emerging Equities, both are focused on the mid-cap space itself. So, if this is the entire portfolio, then you can see that the 100% is in mid-caps, which is not a viable option for any person because it increases your risk unnecessarily, and any balanced portfolio needs a mixture of exposure across large, mid and small caps so that there is stability in the portfolio. At the same time, there is scope for growth. Now, Lalit's time horizon is 15 years. So obviously, having an all equity portfolio is the way in which he can manage it. But that doesn't mean that the portfolio should not have the required amount of internal balance across market caps. So definitely more funds need to be added. Specifically, large cap or flexi cap can be added immediately. Later on, a small cap can also be added so that there is an equitable balance there. And there is also no need to continue with two mid-cap funds which are already being invested into. A part of that money can be diverted to the large and the flexi cap.
All right. We move on. We have Rajiv Bhargava on phone line with us. Hi, Rajiv. How are you doing?
Hi. Yeah, I'm good, man.
All right. So you have just invested in one fund, or this particular fund is something that you want to come out of because of non-performance, UTI Flexi Cap, I believe. Okay.
Yeah, I just wanted to know the feature of this fund because I have invested around a year and a half back.
Okay.
And the performance has been very, very poor. So I just wanted to know feature of this.
What?
Should I hold it for some time or should I come out?
Do you have more funds in your portfolio?
Yes.
Okay. And which are? If you can just name them.
There is a Mira Asset, there is a...
Which fund of Mira Asset?
Large cap.
Okay.
Then many other funds are, right now I don't have the list actually.
Mm-hmm. Okay. Yeah. All right. Although it makes sense to, know your entire portfolio and then suggest an exit strategy from a particular fund. But then, Arnav, how can we help Rajiv? UTI Flexi Cap is something that he's not happy with and invested almost 1.5 years back. Do you think we can give more time to this particular fund, or this is a non-performer in this category?
So if we look at the fund UTI Flexi Cap, it belongs to the Flexi Cap category, which means that the fund manager has the ability or he has the choice to invest across market caps. If you actually look at the kind of exposure that the fund has taken, then it is predominantly large cap with a significant portion of around 30% being in mid caps also, while the small cap exposure is very small. So sector-wise, if you go on to look at it, financials are at the top, followed by technology. And what is significant is that the fund has good holdings, at least as far as its portfolio construction is concerned. But these holdings have not performed well over the last 1.5 years, which is why you see that there is a significant amount of underperformance. I think the 1 year negative return for the fund is in double digits, while if you look at the category average, I think it's just -2 or 3% as a whole. But the problem goes slightly deeper in the sense that even if you look at a 3-year time horizon, while the fund has given returns, it is still underperforming the category. So my choice would be that, I mean, since there are already other funds in the portfolio, it's not like that this is the only one there. One can exit from this fund and if required, choose either another flexi cap fund or allocate the money elsewhere. Because not just because the investor has seen a negative return over the 1 year, but also because of the fact that not just one, but even over a 3-year time period, this has not been able to perform as expected.
What about adding other flexi cap? What fund would that be?
So if there is no exposure to, say, a value-oriented theme, then a parak-parik flexi cap can be a good choice. Otherwise, if you want to go for a normal traditional kind of flexi cap fund from a big fund house, then HDFC flexi cap is also a good option to look at.
All right, we move on and we'll take Tirthankar Das's question, and he's invested in Mirasset Emerging Blue Chip, but he's not happy with the fund's performance and he wants to understand if he can shift to any other fund.
So again, here, I mean, see, one has to always put an investment in context of the overall situation and also the time period for which one is investing in. If you look at the overall market conditions in the last 1.5 years, one can clearly see that there has been tough times, not only just for pure equity as an asset class, but also within the asset class, large caps, mid caps, everything has suffered a bit. Now, Mirai Asset Emerging Blue Chip is actually a fund which invests both into large and mid cap. So it's a large and mid cap category fund. And if you look at it, in the last 1 year, it is slightly on a negative. It is showing a slightly negative return, but it's not a bad performer. So in that sense, if you look at it consistently over a longer time period, it has been a significant outperformer. And just because it has a negative return over 1 year, I don't think that there is a need to change this fund in the portfolio. More time should be given, and you should look at it over at least a 3-year time horizon to see if it is recovering, or if that after that period, if the underperformance continues, then one can look at changing it.
All right, we move on to Vijay's question, and he's invested in Franklin India Blue Chip, Bandhan Core Equity, HDFC Focused Equity, ICICI Proof Focused Equity, and he's doing total SIP amount is 10,000. He's doing SIP of 10,000 in each fund. His goal is to achieve 1 crore in 10 years. He wants to understand the fund mix and the portfolio so far laid down for this particular goal.
So if you look at the portfolio, see, in terms of number of funds, 4 is a good number. It's a good enough number, even though the amount invested is 40,000. But if you look at the kind of choice in terms of the funds, one can see that there is, by the nature of the funds which have been chosen, there is an increase in the risk. So my choice would be that instead of going in for these kind of focused funds or very narrow funds, one should actually look at slightly more broad-based funds in the portfolio. So in this case, my choice would be that remove the investment from 2 of the existing funds, which is, one is that the Bandhan Core Equity Fund and the other is the ICICI Proof Focused Fund. Shift it to a flexi cap and a mid cap fund. So where the flexi cap could be something like a parak-parik flexi cap, which we talked about, and a mid cap fund could be something like an Kotak Emerging Equities. So if you do that, then there is a better distribution of the exposure within the portfolio, and that I think is a better way or a better strategy to go about it, because just having more funds is is just not the only factor. One should also look at how these funds are structured, where they are investing, what is the kind of concentration risk which is in them, and then create an entire portfolio.
We have Anurag Yadav online with us. Hi Anurag, how are you doing?
I'm doing good. Thank you very much.
Thank you so much for sending us your query. We have Arnav Pandya who will sort out your portfolio today, and you are doing SIP of 1 lakh a month. You've got quant small cap and you have PPFS flexi cap, right?
Yes.
Okay. Apart from that, you have lined up your goals as well. Anything else you want to add in your portfolio or the question?
Not really. The main question was whether these funds will meet my goal or not. And I just have, I plan to invest only for next 10 years.
Sure.
And then after 6 years, every 4 years, I will have to withdraw certain amount of money.
Sure. Okay. So Arnav, let's take his question goals wise. What should we start with?
So I mean, the goals come every few years, and rupees 30 lakhs needs to be taken out for the goals. Now, if you look at the total amount which is being invested today, 1 lakh per month, and if that is continued for the entire duration for which the goals are there, then achieving the goals is not going to be a problem. But here the thing is that after 10 years, if the investment stops and then the withdrawals continue, in that sense, there is no addition to the corpus, and at the same time, that corpus also keeps reducing. If that happens, then the achievement of the later goals will most probably not be possible, because the corpus would not be big enough to sustain those kind of withdrawals over that longer time period, because there are not just 1 or 2 withdrawals. I think there are 4 withdrawals which are planned. So in that sense, stopping after 10 years could lead to a problems in the later goal. So that question needs to be reviewed. The second point is that, see, the expectation here is that an average rate of return of 15%, which I think is a bit on the higher side. One should be a bit conservative and plan using a slightly lower rate of return, which could be around 12%. Now, if you get a higher rate and you achieve your goals easily, that's a bonus. But one should not expect the 15% rate and bring that thing down. The third thing is that if you look at the existing portfolio and the funds which have been selected, there are only 2 funds. And out of that, 80% of the amount, and which is a large amount, 80,000 per month, is going to just one particular fund, which is the Parak Parik Flexi Cap Fund. So this is not a good strategy, because there can be times when a particular fund doesn't perform even though the overall markets are doing well. And which is why we always say that in your portfolio, have at least 4 or 5 funds across various market caps. So at least there is some diversification where you have an opportunity where something is performing. So the idea should be that reduce this kind of excessive exposure to a single fund, add something like a mid-cap fund, a large and mid-cap fund, or even a pure large cap fund to the mix, which will then broaden the portfolio, and you can have funds across various fund houses also, which will give you a diversification across the style of management also, and which will be a better option.
All right. Anything else that you want to know from us?
Just one last
Sure.
question.
Sure.
Should I add a flexi cap then? In addition to the Parik flexi cap, should I have like HDFC flexi cap? I see that it's rated at the top these days.
Sure. Arnav, one more flexi cap? Should he add?
No, my choice would not be to add one more flexi cap, and that to HDFC flexi cap just because it's doing well. I mean, you can go for a large and mid cap fund and a pure large cap fund also, where you can even look at a passive fund, because what will happen is that, see, a flexi cap fund, around 70% of the exposure is already in large caps. So if you are getting that similar kind of exposure in another category of fund, I mean, it's good enough. You don't need to have another flexi cap fund.
We move on, and we move on to our next question, which is from Nagesh, and he wants to know which is the best small cap. He's currently invested in Axis Small Cap, SBI Small Cap, and PGIM Small Cap, and the returns are almost the same. He wants to exit, and if at all he decides to do, which fund should he be exiting?
See, again, it's a question of how you are looking at the portfolio and composition and how its construction. because one has to understand the category where one is investing into. The small cap category consists of actually and more than a few thousand stocks, because anything which is beyond 250 in terms of market cap actually falls into the small cap category. Now, when a fund has such a wide area in terms of choice for its portfolio, it becomes very difficult for someone to pinpoint a particular fund and say that this is one which is either going to do well or is going to consistently do well also. So in that sense, there is likely to be several funds which keep doing well at different points of time based on what kind of exact holdings that they have. So that is one thing. The other point is that, see, having so many small cap funds might look like a good strategy, but if these are the only funds in the portfolio, then it makes for a bad strategy, because I mean, having too much of high exposure to just a particular part of the equity market is not smart. It requires an exposure to large caps to bring stability into the portfolio. So that if this is the only holdings in the portfolio, then this kind of exposure to only small caps needs to be reviewed. The third part, which is that if there is a specific question in terms of if there are these three funds which are virtually giving you a similar kind of return, then which is the one to exit from, Axis would be the choice, given the nature of the question.
All right. Thank you so much for being on the show, helping our viewers with their financial portfolio today, Arnav. And on that note, we sign off, and I'm going to leave you with our WhatsApp number and email ID where you can send us your financial portfolio queries. Thank you so much for watching. Goodbye.